Okay, imagine for a second that you're sitting down, coffee in hand, reading the morning headlines. On one page, you're seeing intense reports of military strikes and major international conflicts. But then, you flip to the business section and you see that your retirement portfolio is having one of its best days ever. It kind of feels like a glitch in the matrix, right? Well, welcome to today's explainer, because that glitch is exactly the massive financial mystery we're decoding today.
Let's dive right into this giant contradiction. Bombs are dropping, international relations are incredibly strained, and yet, stock portfolios are just climbing higher. Human instinct naturally tells us that war and instability should trigger widespread financial panic, mostly because investors absolutely hate uncertainty. So how on earth is Wall Street managing to hit near-record highs while the Middle East is actively engulfed in conflict?
Just to show you how real this momentum actually is, take a look at this. Following the Memorial Day holiday, the S&P 500 just rose 0.5%. Now, 0.5% might sound like tiny potatoes to you, but in the context of the broader market, that 0.5% push puts Wall Street incredibly close to absolute all-time record highs. And we're not just talking about an isolated surge in one weird sector. It's the whole shebang. Across the board, from the Dow Jones Industrial Average gaining 53 points to the tech-heavy NASDAQ Composite climbing an impressive 0.8%, the numbers are undeniably green today. Every single major index is brushing up against its historical ceiling, completely defying the ongoing geopolitical volatility. So what's actually driving this totally unexpected optimism? This is the million-dollar or, maybe trillion-dollar question right now. What is the invisible force propping up the market while the world seems so unstable? To figure this out, we're going to have to play financial detective. Let's start unpacking the clues, starting with the geopolitical landscape itself. Clue number 1. Progress in Iran talks. While our daily headlines are totally dominated by military action, the markets are paying very, very close attention to the whispering happening behind closed doors. Looking at the timeline, we see a fascinating shift. We started with some severe escalation in late February when the US and Israel launched strikes on Iran. Recently, the US military reported conducting self-defense strikes in southern Iran, targeting missile launch sites and boats laying mines. But right now, the needle is actually moving away from those kinetic strikes and toward active, stabilizing negotiations. You see, the market isn't looking in the rearview mirror, it's pricing in the future. And honestly, this quote brilliantly illustrates the market sentiment right now. We recently heard from US President Donald Trump, who stated that negotiations with Iran are proceeding nicely. Now, even though fighting continues in the region, those two words, proceeding nicely, acted like a massive pressure release valve for Wall Street. It brought a much-needed wave of hope to investors who are seriously bracing for the worst. But let's pause for a second. It's easy to look at a quote from a politician and wonder how on earth that actually moves a multi-trillion-dollar stock index. I mean, words are just words, right? Well, to answer that, we have to look at how global conflict directly impacts corporate wallets and the actual physical costs of doing business around the world. Which brings us to clue number 2, the oil price ripple effect. If geopolitics is the storm, oil is basically the barometer. It's the lifeblood of the global supply chain, and let me tell you, it absolutely hates conflict. Brent crude, which is the big international benchmark, just jumped 3% to $96.25 a barrel. But context is everything here. That jump was actually oil recovering from a massive 7.1% drop just the day before. US crude saw similar swings, falling 3.8% to roughly $93. This kind of financial whiplash is exactly what keeps corporate CEOs awake at night. So, why the whiplash? Well, the conflict disrupted shipping in the Strait of Hormuz. This narrow little waterway is absolutely critical to global oil supplies. When ships can't safely pass through there, fuel costs become a terrifying unknown for major companies. Just imagine trying to set your company's budget for the year when your primary expense could literally double overnight. What's really interesting here is how easing tension instantly dictates winners and losers. Because there's sudden hope for a diplomatic deal, oil prices cooled down enough to ease those fuel cost fears. Look at travel stocks. United Airlines soared 4.5% and Carnival Cruise Lines jumped 3.7%. But then, on the exact same day, we have companies like AutoZone dropping 8.2% for totally unrelated reasons. Let's actually zoom in on AutoZone for a second because it proves a super important point. Not every single stock moves purely on geopolitical news. AutoZone fell strictly because of slight revenue misses in Brazil and Mexico, which their CEO, Phil Daniele, pointed out. Funnily enough, their actual profit beat estimates, but Wall Street punished them anyway just for that regional underperformance. It just shows us that beneath the big macro geopolitical story, standard corporate earnings still matter deeply. Okay, so we've established that the easing of oil fears created a stable foundation. But a stable foundation doesn't just spontaneously push you to record highs, right? It just stops you from crashing. For the real heavy lifter in today's market rally, we have to look away from the oil rigs and look toward the machines.
That leads us to clue number 3. Tech stocks lead the charge.
Honestly, tech stocks are essentially just putting on noise-canceling headphones right now and ignoring the geopolitical noise entirely. Their engine is completely fueled by the artificial intelligence boom. This promise of AI demand is acting as a massive counterbalance to all that international instability. Investors are so completely captivated by the transformative potential of AI and the immense computing power required to run it that they're willing to pour billions into the tech sector, effectively shielding the broader market from the turbulence in the Middle East. To see just how insanely strong this AI hype is, look at this jaw-dropping update. UBS analyst Timothy Arcuri completely shattered previous expectations for Micron Technology. He didn't just bump up their 12-month price target, he effectively tripled it, raising it from $535 all the way to $1,625. That is a massive vote of confidence. And the market reaction? Instantaneous. That single analyst upgrade caused Micron to surge over 11.2% in early trade. When a massive tech company surges that hard, it basically acts like a gravitational pull, single-handedly lifting the S&P 500 and the NASDAQ right along with it. It's the perfect example of how AI optimism is just completely overriding global fear. So we know the U.S. markets are actively balancing these Iran negotiations with incredible AI hype. But are these specific U.S. variables rippling across the rest of the globe? How did the rest of the world react to these exact same developments? Are they feeling the same optimism, or is the U.S. just living in its own bubble right now? Let's check out the resolution, a look at global markets. Stepping back, we find the international response is definitely a mixed bag. The U.S. market's enthusiasm wasn't necessarily contagious everywhere. Check out this breakdown. Over in South Korea, the Kospi enjoyed a massive 2.5% rally as they reopened following a holiday. London's FTSE 100 also edged up a respectable 0.7%. But then you look at Japan's Nikkei 225, which actually slipped 0.2% after hitting its own record highs in the previous session. Different regions are having very different reactions to the exact same global climate. And just like we saw with AutoZone in the US, local corporate issues can heavily weigh on foreign markets too. Over in London, localized corporate drama really dragged down individual shares. BP saw its shares fall 4.7% after the company abruptly removed its chairman over concerns regarding governance standards and conduct. It's a stark reminder that even in our hyper-globalized economy, local corporate governance still deeply impacts stock performance. So, what is the crucial point to take away from this explainer? It's understanding this market paradox. Right now, Wall Street's momentum, which is fueled by generally strong corporate earnings projected for early 2026 and just immense AI optimism, is currently strong enough to outmuscle the very real fears of global conflict and volatile oil supplies. It is a massive tug of war, and right now, tech and corporate resilience are winning. But the real question we have to ask ourselves as we wrap up is this. As diplomatic negotiations in the Middle East continue and the AI hype reaches an absolute fever pitch, how long can this balancing act truly last? Will an unforeseen escalation break the camel's back? Or will a tech boom usher us into an entirely new era of market resilience? It's a fascinating time to be watching the markets, and we'll be right here to decode the next twist in the story. Thanks so much for joining me on this explainer, and I'll catch you next time.